Hey guys, it's Adam Rose, Vice President, Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. This is another episode of the Mortgage Guy podcast, and today you are going to get to know Phil Moeller of Moeller Real Estate, who dives into real estate investing, portfolio, and all that fun stuff.
Yep.
And he's going to kind of talk to us about how he finds properties, what's a good prospective property, what you need to look for in these types of things, investments in general, and a little bit about his company. So, Phil, I appreciate the time, you coming over here, and I know we've been messaging back and forth for like the last 2 months once we get this off the ground. So hang on tight. Yep, we got to find some time. So thank you again for coming on. But, Phil, I'll tell you what, just so our audience can get to know you a little bit better, where are you from, a little bit of background on yourself, are you married, family, and all that?
Yeah, perfect. So we're in Adam's office here in Sydney, Ohio. I worked in Sydney for a long time at Emerson or Copeland. I'm originally from Maria Stein, Ohio, which is about 30 minutes away from here. I grew up in a large family, entrepreneurial family. Married my wife, Marcia, 15 years ago. She was also from the same area, St. Henry, Ohio. We have 5 kids ourselves, ages 12 to 3.
That's a lot.
Yep, that is
busy much.
They keep us busy, especially right now. We're in midst like softball, baseball, and just chaos and some summer travel. So
we just finished baseball, and it's a lot. And so, when the season kind of ends, you're like, oh, it sucks. And it's like, whoa, but I just got all this free time.
I just had this conversation this morning with someone like, it's fun, but there's some breathing room now. So we just have a couple practices and tournaments, but it's slowed down a lot, which is it's fun, but a breath of fresh air to have some more free time.
Yep.
So anyway, I grew up close to here. I'm a local investor. Went the corporate career route, so I went to school at Ohio State for engineering, and then worked at Emerson for a long time. During that process, started buying real estate, and we'll get into that more. But at a high level, that's my background.
Right. So we went from corporate career. What did you major in over Ohio State?
I majored in engineering. I did that for a couple of years, and then I went into kind of more the business side of things at Emerson. So you went from this corporate structure of business and what you were doing for a living. You kind of moved into real estate. So what kind of piqued your interest into diving into that piece of it, like the real estate side? Yeah. So I didn't buy my first house until 2013, but in the 2008, 2009 timeframe, I got into just self-development, just business books, leadership books, things like that. That ended up helping me in my corporate career. But I also read a book called Rich Dad, Poor Dad, which kind of changed my perspective on money, financials, time, and financial freedom, things like that. And it sparked my interest, combined that with my kind of entrepreneurial upbringing, and I wanted to do something different. So in 2013 is when I bought my first single family home.
All right. Yeah, I had bought my first investment property straight out of college.
Yeah.
So I graduated in 2008. I bought it in 2008. Crazy time.
I'm a slow learner.
Yeah.
It took me a while.
Yeah, straight out. And I've always been kind of immersed in it. Right? I've always been around it just because this is our family business.
And you understood it, right?
And I kind of understood it. But yeah, it's a great opportunity. So, but you moved away from corporate. You went straight back into real estate once you kind of built up a portfolio and found out like this is what I want to do.
Yep.
Right? This is it. So when you are going out and looking, and we'll talk about your company and other opportunities for people inside your company. But when you're going out and looking at investment properties, like how are you evaluating them? And I know there's different ways to do such, whether it's appreciation value and how much money you can make on a flip, or what's the cash flow of this property versus everything else. So how are you searching for some of these investment opportunities? Like what's that process look like?
Yeah. So first, from 2013 to 2017 was single family for me. Then 2017 to today is more multifamily. So a little bit two different perspectives there, or approaches to how you might find deals or find properties and how to evaluate them. First, as an investor, 5 ways to make money, right? Cash flow, appreciation, principal payoff, forced appreciation or a value add, which you can do, and then the tax benefits of it. So that's what I like. And I think the first question people need to ask themselves is, why are they looking for a property? What is their primary goal? Is it just for long-term equity growth? Is it for cash flow? Do they want to exit a job? So start with why. Quite frankly, ask that question first. And then once you get into the details of it, if you're looking for a single family home, first of all, I would say align it with your goals. So if you want high cash flow, maybe it's a lower price point and higher cash flow, but you got to be cautious of that because you might have higher turnover, vacancy costs, things like that with a single family in a lesser area. But location, right?
Yeah,
that's
all
important.
Location.
And then just build a basic financial underwriting model and stick to it. And the other thing I would say is build a team around you of people that are resources, title companies, real estate agents,
lenders, bankers, everything. Yeah,
people
insurance.
that know the market, tax CPAs and attorneys. Just build a team of people around you. Don't try to figure out everything yourself.
It's a little overwhelming.
And let them guide you in the process, especially for single family. I think a good real estate agent that knows the markets, understands rents and values, even economic activity in the area is important. So just have a process and then have a team around you as well.
Absolutely. I mean, because you can dive into this and really get it over your head fast.
Yes.
I mean, fast.
Yes.
And so I agree that you kind of need to set your goals on, hey, what do I want to accomplish here? Am I just simply looking for, hey, I don't have a pension at work, so when I retire, I have my 401k, other investments, but I need some other steady form of income? Then you might want to structure your, the way you approach this completely differently than someone's like, hey, you know what? I'm a weekend warrior and I want to flip a couple houses. That's going to be completely different how you approach this.
And I think your personality type. So for me, I was an engineer by trade. So I was over analysis, kind of frozen, stuck. Quite frankly, I was getting to a point where maybe real estate agents didn't even want to work with me because was I ever going to buy my first property?
You're the guy that reads every page at the closing table.
That's our joke. Now I sign pretty quickly and I'm trusting, but early on, and I think what's my point of that though is if that's your personality type, or if you're just analysis paralysis, if you're buying your first investment or shifting your types of investments, your investment strategy, understand the risk that you're getting into, and I call it asymmetric risk. A lot of times, the upside on the downside is very easy to understand. I might lose this much money.
Sure.
Here's my mitigation plan. You can probably wrap your mind around that. What you can't typically understand is what is the upside. The upside of the first house I bought, my thought process was, okay, I can cash flow a couple $100 a month. The real upside of that was it gave me the confidence, just the knowledge, whatever, to go. Like I learned from that process.
Yeah, it's a trial by fire.
And then I went and I did it again 4 months later, and then 4 months later, and it kind of snowball started rolling. So
and
the upside is what you learn, not necessarily the result.
And when you were buying back in 2013 in that era, the housing stock was a little less expensive, and if you hung on to those single families, because single families, they sell great, right?
Yes.
So much easier to unload versus a multifamily property.
Correct.
Right. Multifamily is going to give you better cash flow, of course, if you plan on hanging on to it for long term. But man, if you were buying and flipping in 2013 or hung on to it for 10 years,
yes,
that's worth a pretty penny today.
Yeah.
Right?
So our single family portfolio, the benefits of single family have been the ability to get into them, right? To just simple financing. If you have tenant issues, you can turn it, you can re-rent it, you can sell it. You have a lot of exit options and fairly quick. It's more liquid than a multifamily for sure. You're looking at maybe 45 to 60 days versus a multifamily. By the time you get it listed with an agent, figure out the pricing and sell it is typically going to be at least 6 months, if not more.
Right.
And it also can depend on the market cycle. So single family served us well, but it ultimately what led us to multifamily was the ability to scale a little bit more.
Right. That's what I was going to ask you about pros and cons of looking for from an investment opportunity, looking at homes, whether it's single family, multifamily, 1 to 4 unit versus apartments.
Yeah.
Right? I mean, how does that look? What's that approach? Because you're going to look at and evaluate each property a little bit differently, right?
Yep.
The dangers of possibly going into multi-unit. When I mean multi-unit apartment complexes, we're talking 14 units, 20 units, 50 units, whatever it might be.
Correct.
What are some of the downfalls or issues you run into with that style of property versus 1 to 4 unit?
Yeah. So first, I would encourage people. There's a lot to learn in single family or 1 to 4 unit.
Yes. Start small, guys.
And then you can go from 2 units to 4 units to 8 to 16, and you can kind of build your knowledge with your portfolio. That's how I did it. You could do it faster than I did, but that's a good process. Some positives of multifamily. The single biggest one is the value add component of it. So the way single family houses are valued is how well kept and nice is the property. What does it look like? You're selling it to an emotional buyer. Right.
Yes.
It's not based on the income of the property. Whereas in multifamily, you might identify a property that has, a lot of deferred maintenance or CapEx or upside in cosmetics where you can demand more rent. Maybe you can run it more efficiently. If you improve the operating income of a multifamily and run it well, you're inherently adding value to that property just by the formula of how multifamilies are calculated. And that, I think that's even true to an extent on a duplex or a quad, especially true for as you get into 20, 40, 70, 100 unit properties.
Mm-hmm. Right. So financing is completely different, right?
Yes.
Financing is my world. 1 to 4 units is not a problem, especially for non-owner occupieds. It's not too difficult to complete.
Correct.
Now, once we get over that and hit that 5th unit and call it commercial now, right? Yep. It's a whole new world of lending.
Yes.
Is there anything that you could expound upon that? Like, hey, what kind of financing options are there out there? Whether it's commercial lending, do you have private capital? Because your operation is obviously different than someone that might be starting out. So what is, if you don't mind me diving into, how does it look for your operation? So if you found a 5 unit, 8 unit, whatever, how does that look on the financing side for you?
So first, as I said earlier, building a team around you is important. So good title company, good banks, not just a single bank all the time, but multiple banks that you can go to, be transparent and honest with them that, hey, you're talking to multiple people, but building relationships with other companies and financing institutions is important. When you're looking at a multifamily property, how easy you are to work with and how easy your bank is to work with is a selling point to a broker that wants to sell you a property. If you're easy to do business with, if your bank's going to close, if you're going to get the appraisal done, all that, just you're an easy buyer, that is going to get you a deal over maybe an
unknown.
An unknown or a pain in the you-know-what buyer. Yeah. So that's just from a relationship perspective, that's important. And then the financing structure, as you said, is very different. A lot of times for a single family house, your first one might be a 30-year fixed.
Right.
Whereas you get into commercial loans, what we've done is typically a 20 or 25-year AM. Yep. We locked up. It's the fixed term is typically 5, so 5 years fixed, and then every 5 years thereafter. So we're pretty well protected from an interest rate perspective. In the last couple of years, if rates have gone up, our rates have stayed the same. Now, in 3 years from now, they might get popped by a couple %, but we'll be in a good position income-wise to be able to absorb that. So just be really smart about that. Depending on your strategy, you might look at prepayment penalties and other things if you're looking to sell.
Yeah, there are. Remember, guys, when you're looking at commercial lending, there are some different requirements thereof in regards to down payment terms. Like you were mentioning, rates are slightly different. Pay attention to prepayment penalties.
Yes,
that's a big one. Okay.
And the big thing when you're looking at any property is just your debt service. I mean, the banks look at this for a reason. The debt service coverage ratio is really important. Mm-hmm. I like to be at 1.25 out of the gate, but with a plan to really grow that to 1.5 or even 2x over the course of a couple of years with value add. And again, there's a reason the banks look at that number first because it's really important. And if you look at that and pay a lot of attention to it, it's going to protect you.
Yeah. So, on your website, you talk about passive real estate investing and passive income on real estate investing.
Yep.
And is there anything you can expound upon that for our audience for education purposes, what that means and what that looks like?
Yeah. So first of all, a lot of people, whether it's other podcasts, books, talk about real estate as being passive. I think real estate is a spectrum of very active to very passive.
Correct.
If you flip your own homes and you do everything, you're active. I mean, it's in a way a job. Whereas as a completely passive investor is you are investing capital, you get a quarterly distribution and a quarterly communication. Now there's still work. You need to understand what you're doing to be a passive investor, but those are, and then there's a completely
different ballgame.
And there's a bunch of different spectrums in between. So, right now we have a portfolio of properties. We have an employee that manages them or third party. So it's it's a mix of active and passive. What you're alluding to as an opportunity for passive investors is in real estate syndications where let's say
a REIT.
Yep. But it's private. So
correct. It's not as large. REITs are very, very large investment opportunities into real estate. He'll go ahead and explain the private side.
So like on a private real estate syndication, let's say there was a 100-unit property. I'll just use round numbers here for easy math. That was $10 million acquisition. Well, I don't have 30% down to bring to that property of $3 million. I might raise private capital to invest in that. So $3 million of private money. I, of course, would bring some of my own capital too, but bring that capital. And then I'm running the property. I'm the general partner on everything. But at a high level, those investors get 70% of the ownership pro rata to their investment amount. So it's an opportunity in general. the industry, you can get around a 15% projected internal rate of return. But the numbers only mean so much. It's really important when you're looking at private investments, passive investments, to know who the operator is.
Yeah, so I was going to say, who's running the show here?
That is the most important thing. A bad
Absolutely.
operator can make a great deal in a great market go bad. But look at the operator first. Then you're looking at the market, the deal itself, working with someone that knows how to evaluate that. And then putting good debt on it too is really important, because we're going to see in the multifamily space and some other spaces over the next 6 to 18 months, we're already starting to see it, but a lot of defaults on bridge loans or variable rate debt. So just understanding what you're investing in and who you're investing in is really important.
Yeah, absolutely. So that's going to bring us to your company, right? So what is Moeller Real Estate all about? How can people get involved? What does this look like? Because, on your website, it shows your entire portfolio, which I have printed out here, which is very, very impressive over the last decade, right? But you're also open to other people coming in, and that's where we started kind of bridging the gap when we were talking about passive income.
Yep.
Passive income for real estate investors that might not be an operator or ready to be an operator, but wants to get in the game a little bit.
Yeah.
So how does your company operate? How can people have an opportunity for this?
Yeah. So first of all, we host quarterly real estate investor meetups. So these are for active investors. They can be a part of that. We do that in the Maria Stein to sit in Sydney area. So that's a way for people to just get educated if they're active investors. That's one vehicle. We also do webinars occasionally. So we've done webinars on tax strategies. We've done webinars on passive investing in real estate, where the 3 minutes we just spent, we spend 50 to 60 minutes going into more detail on that. So
it's very complicated. I mean, there's so much that you can go down. There's a street, then there's an avenue off the street, then there's little alleyways off each avenue. It's crazy,
right?
How deep you can really go,
right? And then what we're focused on now are really two things. One, we're continuing to evaluate deals. We haven't bought anything in the last year just because there's been a gap between buyer and seller expectations.
Yep.
We think that might come together here. So we're working on evaluating deals on a regular basis where there would be opportunities for others to invest in those. Mm-hmm. So in an apartment syndication, as I talked about. And then the other thing I'm excited about we're working on is setting up like a lending fund or a hard money lending fund where we work with flippers where we can provide them capital. We're going to, of course, do our due diligence on that and make sure they're bringing their own capital. Their credit score is strong. And some other criteria that we have for them. But then we can provide investment opportunities like a higher, 8, 9, 10% fixed rate return to our passive investors too. Right. So real estate syndications on apartments, and then opportunities for hard money lending are two things we're focused on right now in the near term. And again, if people just want to reach out to me, we can connect them.
Tell them how. What's the best way to contact you?
Yeah, you mentioned our website, MoellerRE.com, or just they can email me, Phil@MoellerRE.com. I'm happy to do it. Honestly, I'm happy to do like a 15-minute consult with anyone to help them with their strategy. Maybe some of the challenges they're facing now, I've probably faced them, or I can maybe connect them with others have faced those challenges. So if investors would want to connect, again, I'm happy to do that. I don't charge for that stuff, just to be a part of the network and try to connect and help people out.
Yeah, very good. Hey, so I have to ask. So I have two more questions that aren't even on your sheet that I may ask you about. First off, do you have any projects that you have your eyes on? Anything big that you're super excited about? And are you focused here in Shelby and Miami counties? Do you have anything going on in Montgomery County? Because there's a lot more opportunities on the commercial side down there. There is Dayton area.
Yeah, there is a project.
You don't have to get real specific. I'm just curious.
There's about 100. There's around 100 unit property that we're looking at.
Nice.
I'm in discussions with brokers. We'll probably submit an LOI. I don't know what the outcome of that will be.
Right.
The markets we're looking at are really Indianapolis, Cincinnati, Dayton, and Columbus. So pretty regional. Mm-hmm. We want to be at a scale once you get to 100 units or above, where you can use third-party management. We've had success with our third-party management company on our larger products. So we want to be at that number or above, and then we stay close to that as the asset manager of that property. So I'm cautiously optimistic on that one, but there's still a lot of work to do on it.
Very good, very good. So that's exciting because those opportunities don't come along all the time. So when you find them, hopefully you can make that deal work.
We'll see. We'll see. Yep.
That's good. And then I do have, obviously we're going to put all your information out on the YouTube channel, guys, and we will blast it on Spotify and Apple Podcasts. But one thing I have to ask you is, do you have any crazy real estate related stories? Like anything off the wall, like you cannot believe this happened?
So, man, I don't know if I should say this or not, but I have to. One of them was when we shifted from single family to multifamily. My wife said I didn't sign up for this and yelled. Yeah, it was maybe not the quietest, and then when we shifted to multifamily, our first property on day 3, this was third party managed, fortunately, but on day 3 there was like a butter knife stabbing at the property, and it was on the news, and I was like, what in the, what did we get into? So, that's where the spectrum of active to passive comes in, and I'd rather be on.
You were a little too active on that one.
I want to focus on finding deals, evaluating deals, brokering those relationships with brokers and other investors, and then put the right team in place to help me, including strong third party management teams. So I'm not maybe dealing with those things as much, but
not so much directly.
And then we've had many other horror stories or capital projects that weren't anticipated, so we've definitely learned some lessons.
Yeah, and in real estate, there's never a shortage of surprises, that's for sure. So if you guys are out there watching this and you're real estate investors, you busted into a property, you're doing the work yourself, you always put a little bit more work into it than what's initially expected, because you don't know what's behind those walls. When
I started into it, a guy that I was talking to before I started said, just get ready to meet some very interesting people, and I'm glad he didn't tell me too much, because I might not have started, but we've met some interesting people.
Yeah, that's for sure. Hey, guys, thanks for stopping by. Phil, thanks for being on. A lot of great information. Check out his website, and if this is something that you guys are into, again, it's going to be on the YouTube channel. Click the link and take a look. Thank you for Phil Moeller for stopping by and giving us a lot of information. Subscribe on YouTube. Check us out on Spotify and Apple Podcasts, and we will see you guys next week.
Thanks, Adam. Appreciate it, man.